take you through the concepts of portfolio management for CFA level 1. To begin with, we'll start with an introductory chapter of portfolio management, that is an overview. In this topic, we are going to learn about what is portfolio, how to form a portfolio with various different assets, why it is important to form a portfolio with different assets, and what are the different portfolios available in the market. So to start with, a portfolio perspective on investment. So what is portfolio? A portfolio is a combination of investments in various different assets. So let's say if you have invested in equity markets, and in that equities you have invested in various different stocks, plus you have invested in fixed income securities, plus in real estates like land, then all these investments will make your portfolio. Hence we say that portfolio is a combination of investments in various different assets. Diversification. Don't put all your eggs in one basket. This is a well-known saying in English. So what does it mean? It means that let's say if you have 10 eggs, and if you put all your eggs in one basket, and if that basket falls down, then all the eggs will be broken and you will lose all your investments. But perhaps if you have put 5 eggs in one basket and 5 eggs in another basket, and if one of the basket falls down, then you will still have another basket with 5 eggs. Similarly, it is said that while investing, you should invest your funds in such that you should invest some of the funds in one asset, other part of the fund in other asset, so that even if one of the assets loses its value, then there will be other asset which will either grow or remain flat, and you will still be left with some part of your funds, and your portfolio will at least be balanced. Let's take this example of Enron Corporation. Enron Corporation grew at the rate of 27% per year from the year 1990 to 2000. So if you'd have invested $1 in this company in 1990, then by the end of 2000 your investment would have become $15. That is 15 times return in the span of 10 years. Now this is really very high rate of return, and this lured a lot of investors to invest most of their funds in this company and earn higher returns. A lot of investors who were planning for their retirement had invested all their funds into this company. Now what happened? Subsequently, in the coming years, this stock started losing its value, and from the year, that is from Jan 2001 to Jan 2002, the value of this company fell down from $90 to $0, which means that it lost all its value, and all the investors who had invested their funds into this company had lost their value, had lost their investments. Especially those who were planning for the retirement, it will be difficult for them to. So it is always advised to invest your funds in such a way that you invest some part of your investments in one asset and other part in different assets, so that even if one of the asset loses its value, then there are other assets which are either growing or remain flat, so that your portfolio remains balanced. Now let's take the example of gold and equity. Gold and equity are generally negatively correlated, which means that if the prices of equity market increases, then gold starts losing its value, and if prices of equity market decreases, then gold prices increase. So we saw it in the recent years when the market was in crisis, then people lost their confidence in equity markets and start pulling off their funds from equity market and started investing in gold. Hence equity market started losing its value, but gold market prices of gold increased. Hence we say that these two assets are negatively correlated. And if you have invested your funds in such a way that 50% in gold and 50% in equity, then even though if value of one asset started losing, but the value of other asset was growing, you would have maintained a balanced portfolio. Composition matters for the risk return trade-off. This statement means that the investors are generally risk averse, and for taking extra risk they ask for extra returns. So let's see this example. If you have an option to invest in government securities which gives you 8% fixed returns without any risk, that means if you invest in government securities, you will somehow get all your money with interest. You will not lose your funds at all. So can we say that this is a risk-free investment? Similarly, if you have an option to invest in equity stock, and like we saw in Enron example, there is a possibility that equity stocks can lose their value up till zero as well. So there is a high risk when you are investing in equity stock, right? Now, if you have an option to invest in either of the two stocks, and if equity stock will also give you 8% of return, then will you opt to invest in equity stock? Not at all, because with same amount of returns, you have an option to invest in a risk-free asset which will give you guaranteed returns. So you will never opt to invest in equity stocks. But perhaps if equity stocks give you a return of 11%, then you can think about investing in this stock because you are earning higher returns on it. So the extra returns that you get by investing in risky assets, that is, if you invest in equity stock, you are earning a return of 11%, whereas risk-free rate is 8%. So this 3% is called the risk premium. So risk premium is the compensation for investing in any of the risky assets.